Welcome back to Brazil Crypto Report. Today I'm joined by Luca Prosperi and João Reginatto of M0 Labs. We talk about how M0 is redesigning the monetary vertical stack and democratizing access to money issuance infrastructure. All right, everyone, welcome back. My name is Aaron Stanley, and we have a great episode for you today. It's an honor to be here with both Luca and João, who are two legendary figures from the stablecoin world. We're going to be talking about their new project, M0, which reimagines, really from a fundamental level, the role and function of money in the crypto economy. And it's frankly one of the most fresh and interesting ideas I've come across in a while, so I'm really excited for this conversation. With that, Luca and João, thank you both for being here.
Thanks for having us.
Yeah, thanks for having us.
Amazing. So before we jump into M0 itself, I'd like to focus on your respective journeys to this point. So you've both been like really heavy in the game, in the trenches of stablecoin development and deployment over the last several years. João, you were really the key player at Circle, that bringing USDC to life, and Luca, you were a key player in the MakerDAO ecosystem for many years, which is obviously responsible for the Dai stablecoin. And I'd like to give each of you the chance to introduce yourselves with maybe through the framing of like the successes and the limitations you encountered in these previous roles, and then like what prompted you to decide to work on this new project. Luca, why don't we start with you, and then we'll hand it over to João.
Yeah, absolutely. I'll try to make long stories short, as they say. But I actually started my career not in crypto, but in traditional finance. I was for 15 years plus, like deep financial professional, like advising, researching, investing in banks and financial institutions. So I've always been very interested in the way money is generated, created, transmitted. I'm a mathematician by background as well. So more always looking at the back end of money rather than the front end application of it. There is a lot more behind the balance that you see on a screen. And I actually joined the so-called DeFi revolution when I perceived that for the very first time, there was a movement that was trying to reinvent the way we actually create and distribute money at the most fundamental level. And at the time, Maker was definitely one of the pioneers there. So in pure decentralized system, I started to contribute in some of the forums and just share my ideas. At the time, I was starting to write my own research on a Substack that became quite respected in DeFi called Dirt Roads. And then from there, everything started. Like I became more entrenched in the ecosystem. I started advising some of the funds, investing there, and having very strong opinions about governance. In the same time, I met João, but I'm sure he's gonna tell more about it. But then, until the middle of 2022, I stayed with the Maker project, and then I realized that, in my opinion, these projects are phenomenally interesting exercises, but proof of concepts for something that needs to come next when it comes to scalability and institutional quality of execution. And that's when we decided actually to step aside with my two co-founders and launch M0. But I'm sure we're going to talk about more about M0 later on.
Yeah, absolutely. And João, what about you?
Yeah, I come from a different angle when you compare to Luca. I'm an engineer by training, so I have worked in financial services in banks. Starting in Brazil years ago, I moved away from my home Brazil. But I think out of luck than out of pleasure, because I don't think if you work in technical and engineering spaces, you have pleasure working in traditional financial services, because apologies if that hurts anybody's feelings, but in most of the cases, the technology is like complete crap. But I have had that experience, and I think that's important because in a way, as a technologist, you always want to improve things. And I grew up in my career with the advent of the internet disrupting everything. So I was always curious with, how new and better architecture, especially more distributed and decentralized architectures, could improve a lot of the things that I was touching. And then I came across Bitcoin in 2012 when I was doing an MBA. And that was the best thing that I got out of my MBA years. I like to joke, and I think as a technologist, I got really interested in Bitcoin, and I could see how it could be this sort of native internet form of money. And I started to follow the industry. Didn't do anything professionally speaking until 2015 when I joined Circle then, and I think I just feel like very lucky for many things that happened in sequence in my career, but at Circle, the first thing that I did, I was a product manager for a product they had at the time in 2015 called Circle Pay, which was sort of, as a lot of other products still exist today, sort of a hybrid between a Web 2 and a crypto product, right? So the crypto backend, but trying to come up with a Web 2 experience for people. And we were trying to do things like run cross-border transfers with settlement on the Bitcoin network, which was very cumbersome, but it gives you a lot of experience into, if you're trying to reinvent some of these applications for money, how are you going to go about architecting them from a crypto point of view if you want to build them differently. And then eventually I was tasked with building USDC, which is really a vision that Jeremy and Sean had starting in around 2017. And I always came to USDC or stablecoins more generally at the time, again, from a technology standpoint. That was my main interest. I wanted to use something like USDC to actually rebuild the Circle Pay product that I was working on before and build it properly on top of actual digital dollars with actual fully on-chain settlement. So that was always my interest, and I think I left a little bit of that DNA, as with a bit of developer focus in the work that I've done for USDC.
Brazil Crypto Report is presented by Kaleido. Kaleido is the most trusted digital assets and blockchain company by enterprises. Their product suite is the ultimate business blockchain cloud and is rated #1 for tokenization and #1 for blockchain as a service. Built by veterans of IBM Blockchain and Consensus, the Kaleido platform combines turnkey functionality with enterprise-grade security and scalability to power your application. Learn more and try it for free at kaleido.io.
But then throughout the experience of building and bringing USDC to market, I got to know people like Luca, people like Greg from the Maker ecosystem. And I think we have had many conversations, as you have with the ecosystem, and many interesting points of view. But I think a couple of things that started to become recurrent for me in the conversation with the ecosystem were two things. One, that people, coming across a large-scale stablecoin product, a lot of people become interested in participating in the issuance. Many people would say, I like what you guys are doing, but can I take just the software and run it on my own? Can I white label it? So there's a lot of questions like that I think the large scale issues get asked. And the second type of conversation that is very recurrent, and I think, Luca, we have had a few of those, is how can we participate on the upside, right? So you guys, I have a lot of deposits for this product that you guys have. How can I participate on the yield that you guys make on reserve? And I think those things, in my mind, were telling me that customers were asking for something different. As it's usually the case, customers ask for a faster horse. They don't know exactly what they want. And I kept following Luca and the amazing things that he writes at Dirt Roads. And I realized that I think there was a lot of alignment of minds with what Luca was building at M0. And then I was fortunate that Luca made me an offer to join the team, and here we are then.
Amazing. That sets the table nicely here for the conversation. And I think it's super interesting that you guys come from, it's like similar, but different enough, divergent enough backgrounds. Obviously Maker or Dai is the largest like decentralized stablecoin. Circle is or USDC is one of the largest or the second largest centralized stablecoin, but they both kind of come from this like single issuance model, right? Where in the case of Maker, it's the protocol, the single protocol that's doing the issuance. Then in the case of USDC, it's Circle that's doing the issuance. So it kind of sets the table nicely for this conversation and what you guys are building with M0. So there's a line in your white paper that I think kind of sums up nicely the big picture. At least it resonated with me. So I was hoping we could start with that and maybe work backwards. And the line says, M0 intends to redesign the monetary vertical stack rather than build an additional layer on top of what has ultimately become Byzantine infrastructure. And there's a lot in that one sentence, but maybe Luca, we'll start with you. I'm hoping you can tell us like what you mean by that. And then let's dive into like, how does this new system that you're designing, how's this actually going to work?
Yeah, absolutely. I don't know when I came out with this sentence, but I think I keep repeating it. But I like to say that money is the most complicated, mass adopted product there is. Everybody uses it. Most people have no idea how actually money is manufactured. even professionals. Like, when I mentioned in the past, what I mentioned before, that I used to be an investment banker for banks. And, I don't know if people are familiar here with how investment banks are structured, but investment banks have several teams that cover specific industries. And the largest team is a so-called financial institutions group, which is the group that includes the bankers for bankers. And they are in a corner, usually in a separate floor. Nobody knows what they do, because banks are complicated. Nobody really knows actually where the money that you have, the balance that you have on a bank account, where does it come from? People think it's someone else's money. It's not. It is just a balance that is created and is kind of packed and protected by a set of rules that are technological and regulatory in nature. So there is, even if money at the end in the form of a deposit or a stable coin kind of smells the same for issuers, for users, if them in normal times, there is a lot behind it. And I believe, and I'm sure João, with his experience at Circle, agrees with me, that a lot of the efforts that we have seen so far, most of them are actually have been trying to give the look and feel of digital money to the same type of old type of money. So when we mention about like an overlay, an extra layer on top of antiquated infrastructure, think about how most of the so-called centralized fiat collateralized money is produced. Like you have a deposit, you put a deposit into a bank, and the bank gives you some sort of a receipt of that deposit, and then you create a payment token on top that you use in the ecosystem. What it means is that you haven't really touched the way money is created and distributed between central banks, commercial banks, depositors, etc. You're just giving them a digital receipt so they can do something with that money in a different ecosystem. It is like opening a branch in crypto for a regional bank. And I think we can do a lot better than that. Me and João, we actually met when I was researching. We had met before, but we started talking seriously when I was researching stablecoin design, and I was looking at Circle's balance sheet, and I was like, guys, Circle is ultimately a wrapper of regional US banks. And there is a lot of counterparty risk here that nobody's pricing. A regional US bank goes down because they're giving loans or they're mismanaging their balance sheet, and everything goes down. And 2 weeks afterwards, Silicon Valley Bank goes down. And if the US government or agencies wouldn't have stepped in to save it, Circle would have been dead. And I think that João has some stories about, like, horror stories about stress and difficulties during those days. But the point here is that we can do better. And the way we are thinking about M0, which is nerdy, because ultimately for the user in normal times, it wouldn't make any difference. And I'll tell you why in a second, why I keep saying in normal times. But I think we want to redesign entirely how actually money is created and distributed. So instead of just rethinking the vertical, this means also lower risk for the holder, less leakage for financial institutions that now are just capturing economics without adding too much value, and more transparency and more interoperability. So better digital money. That's what we're trying to do. It is an ambitious project, but it is important because in normal times money kind of smells the same. But it is like a turkey. Has the nicest life in the world for 364 days a year. And I think that if you use dollars in the digital age, you really want to make sure that you have the most solid, robust, transparent, and interoperable asset you can have throughout your life cycle, not for 99.9% of your time. So I think that's what we're trying to do. And we are starting with very pragmatic steps of what we want to do next, because obviously between here and a vision of redesigning global money, there are a lot of things we need to do in order to create a sustainable company and make our investors happy as well.
Yeah, this idea of a lot of this innovation that we see, whether it's in fintech or in crypto with stablecoins, is really just kind of a wrapper on the existing system. I mean, this this kind of hit me a few years ago. I went to Money 2020 for the first time, I think in like, 2019 or 2018 or something. It's like, oh, here's all these beautiful products, and they have all these, cool apps that you can use to divide your restaurant bill amongst different people, or, apply for student loans. And it's really nice user interface. But it's like all this stuff is just running on the same old system, right? There's nothing, it just looks nicer to the end user, basically. It's not really, there's nothing really new here in terms of how the money is being issued or distributed or anything like that. And I've always kind of had that same feeling about the stable coins. When stable coins first started coming out in 2017, 2018, I was kind of like, why are people like really excited about this? This just feels like another fintech product. But obviously there's a use case for it, right? There's a need for just having like a stable dollar pegged asset on chain for trading and to some extent payments. But it felt like I didn't quite understand why people were getting so excited about it in the crypto world, because I thought we had kind of more than this I thought we were trying to do more than this, basically. João, I'd like to get your thoughts on this with, Circle and you built USDC has become a tremendously successful product. And I'd like to get your just thoughts on what were some more of these limitations that you, I know one of the big ones you've mentioned in the past is really the interoperability issue, where, if you want to go from USDT to USDC, which is in theory the same value asset, you can't just swap those two. You need to pay they're not interoperable. You have to go to exchange, you have to swap, you have to pay the fee, whatever. What are some of the other maybe limitations of this type of model in your view that you kind of encountered as you were building out this product?
Yeah, and don't get me wrong. I think it's natural that things evolve in this way, right? I'm not a fan of rationalizing by analogies, but one analogy that I was talking to another person the other day was, because I think we're all kind of around the same age, so we all grew up with the internet all of a sudden changing things for us, right? And I remember reading the first few versions of the New York Times online, and it was a scan of the physical paper as a PDF, like that, available in downloadable form, online. And even that, today we look at that and we're like, wow, those guys were ridiculous. They didn't know what they were doing, and maybe they didn't, but even that form factor was already superior to the New York Times at the time, right? Because if I didn't have access to the physical printed distribution version of the New York Times, all of a sudden having a PDF online, if I was in the countryside in Rio Grande do Sul, right? That was something that I didn't have before, and and all of a sudden it could reach new people, and it had no borders, and maybe it was nearly free. I think these initial stablecoin products, they are that, right? They might, and I think they continue to evolve, but in those fiat collateralized products, a lot of them are a wrapper of the existing banking and financial system, right? But they put those dollars on the internet, and they allow people to have access to that product without borders, for nearly free transactions. And I think that was the appeal, particularly for the crypto industry in the beginning, right, where everybody wanted to settle all these crypto capital market transactions, and they wanted to settle that in dollars. Stable coins were the perfect product market fit for that. But as you said, then you start spending years and years thinking about those things, and you realize the several limitations of that, right? I think number one, to touch on the one that you said, and then I'll mention a couple of others, and I'm sure Luca can complete. But to touch on what you said, there's very little technical innovation in those products when you look at them, right? There's actually a lot that sits below sort of the iceberg line, but the part that is quote unquote crypto, the part of the tech that actually lives on chain, is usually a very, very simple ERC20 smart contract. I mean, very, very simple. Really, there's the innovation in that space for the last number of years has been minimal, right? Has been around things like how can we make the transfers cheaper? How can we run this on different blockchains, et cetera, et cetera. But it just so happens that everybody is deploying the same technology separately. So everybody's like, no, I'm going to deploy my own. The other day I saw this, some central bank digital currency was saying that they have even their own ERC20 smart contract, as if it was like a great piece of innovation. I mean, it's the most commoditized piece of technology there is, right? But everybody keeps deploying it separately and fragmenting liquidity, because the moment you deploy it separately, it's a completely different non-interoperable asset. And then people have to go through the price discovery if they want to swap one for the other. People have to redo like business development, to get those new assets kind of listed and available and integrated in all these places, these venues. So it's just a tax on the system. It's just a waste of resources that everybody keeps deploying. Again, the technology is the same. If we could figure out a way for everybody to become, perhaps parts of a broader network where they can all share the same technology, it would be much more productive. But I think also on the business model, there's a lot of limitations, right? I think my feeling is that the vast majority of the value add in that sector is actually in the utility of those products. So it's actually in the venues that are creating the use cases, right? The centralized crypto exchanges, the wallets, the fintech applications, the cross-border payments applications. Those are the folks who are doing the hard lift, the heavy lift, right? So they are creating customer relationships. They are acquiring trust from all these users. They are acquiring then the deposits, right? They're hosting and custodying the deposits for those customers, and yet they're not participating in the business model of monetizing those deposits. I think to me at this point, it's almost like it is inevitable that model is bound not to be sustainable and it's bound not to work. And eventually, and I think it's already been the case for years, but eventually these venues that control the customer relationships, they're going to say, hold on a second, I need to participate in this. I think those to me are some of the bigger issues, but actually there's a long list, as Luca said, when you look from the top to bottom of the stack, there's a huge amount of opportunity for improving it.
So with that, Luca, why don't you give us a rundown of like, how are you guys trying to solve these problems? I know you guys have built this system of kind of a multiple issuer system where you have multiple entities that can issue this one type of money that is, and you have a decentralized system for basically ensuring that this money is backed by pristine collateral, essentially. But maybe walk us through like what you're envisioning here and how you're attempting to rectify some of these problems that we've been talking about here.
Yes, and I think I want to continue what João just said, and I also like to look at things as macro, right? So now you have the stablecoin market, which is, from a profit perspective, de facto dominated by 1.5 player, and that one player, which is Tether, is the most profitable company in the history of the universe. Now, you can look at this in two ways. You can have the heroic reading that this is just an incredible company, or the rational reading that means that this is the most underdeveloped sector in the history of the universe, because companies should all have normal profits and not just having extraordinary profits. Tether made more profits than Goldman Sachs last year, I believe. I'm pretty sure my Goldman Sachs friends do not know that. But so the current model is a one-to-many model, right? So you have one issuer that connects to many distribution venues. The reason why Tether, for example, is incredibly successful is that the many, so the integrations are several. So this product is everywhere. And so it's useful. Now, the quality of Tether needs to be good enough. I personally do not think is good enough, but doesn't matter. What matters is what people think. And I think the product, let's assume the product is good enough to satisfy those use cases. And then the other point is where the economics are distributed. And now currently the economics are entirely distributed to the one, and then the one rebates something across the system, of course, to keep the distribution going. Now, I think this model obviously is not sustainable for a few reasons. First of all, the good enough element keeps evolving, because as you keep expanding the use cases, the standards also get higher, right? If you want to use a stable coin for retail trading and settlement, is very different compared to using a stable coin to park all the money of an institution in Brazil. I don't know. I'm just making examples, right? So the standards are changing. The second point is the economics are so attractive that everyone wants to replicate the same model. But the third point is that it is very inefficient to do that, because you cannot have several one-to-many business model, because then everyone is fighting for the same user venues. And as João was mentioning, is fractionalizing liquidity, and is fractionalizing also the way things are generated in the first place, and confuses the users. So what M0 wants to do is not a one-to-many, not a model, but a many-to-many model, where we always joke that money has an upstream and a downstream portion of it. Upstream, how you create it, downstream, how you distribute it. And we want to enable many issuers to actually mint the same type of asset. So the standards are higher and keep getting higher consistently across the network. We want to enable the issuers to be supported by a list of collateral storage providers, by a list of validators that keep improving. So a network that improves and democratizes the upstream part of money. And then we want to focus the protocol on technology, like what João was mentioning, way beyond an ERC20 plain vanilla token, so that the downstream is also more sophisticated. So the way stablecoin can connect to fintech, can connect to payment rails, can connect to other DeFi use cases is better. So the idea is, pragmatically, you are a large venue, you see the profits that Tether is making, and you want to actually launch your own stablecoin, but you launch your own stablecoin is complicated, you're fractionalizing liquidity, you're fighting on the same pie. What M0 wants to say is, like, instead of going on your own, just become one, like just another data, like point node into the network, so you can benefit from scale economies. This is a scale economy product. So I think this is like, we are completely changing the business model. In doing this, as I mentioned before, we are raising the standards because we want to keep raising the standards so that the distribution venues can expand beyond retail trading. And also, we are redesigning the way economics are distributed. So instead of just keeping all the money at the issuer's level, we do not want to create a bottleneck at the center that keeps all the money in the protocol, but actually the protocol helps a smarter and more fair redistribution of the economics in the network. So we are actually creating a network that can mint the same, where parties perform certain roles, they get compensated by it, and can mint an asset that smells the same, is fully interoperable, and the standards of quality of these assets keep growing with time. So it's in order to do this, we are doing a few things, right? So we are creating the core protocol, which is some sort of settlement layer, let's say, for actors to perform actions, proof of reserves to be provided on a daily basis, stablecoin to be minted and redeemed, yield to be distributed, etc., etc. We have created a governance module that helps governing this system, and I'm sure we can spend a bit more time on that. Because it's a sophisticated module. And then we are developing a set of software tools for different agents in the ecosystem to perform certain actions. And if this goes well, the ultimate user shouldn't care. The ultimate user should just have a better product, but the rest of the network will care. And we are reaching now a breaking point where the rest of the network doesn't want to do the heavy lifting to make money for one institution. And also, even if this institution was the very, very best in the world, network states taught us that it is not a resilient equilibrium where you're running incredible amount of liquidity through one channel. So, the three of us, we have deep connections, or we spend significant time in Latin America. Even assuming that Latin America would run dollar-denominated use cases on stablecoin, definitely we do not want one continent to have the counterparty risk of one issuer for their financial use cases. I think we can, even if whatever the quality of this issuer, we can do better. So we really want to move from a one-to-many business model that is replicated several times in parallel to a many-to-many network that can absorb most of use cases, most players, and increase transparency and standards of operations as things get more complicated on chain.
No, thank you for that. That's super helpful. Maybe just as a way of putting it into like a practical illustration, as you were talking, I was thinking of like PayPal. They launched their own stablecoin probably about a year ago, or maybe at some point last year, second half of last year. And I mean, for them, it makes maybe a bit more sense because they already have the app and they already have a lot of users, and maybe it makes a bit, maybe I'm sure it's a fine product. I've never actually used it, but I'm sure it's fine. But just using them as maybe an example, just for somebody to come out and issue their own new stable coin in today's market when there's such a heavy saturation with USDT and USDC, you're basically fighting against those existing networks. And it's like good luck, like trying to fight against that, like trying to get any kind of meaningful market share. Maybe if you already have your own distribution like PayPal, maybe it's a little bit easier. But alternatively, under the system you're proposing, PayPal could have just come into the M0 network, and they could have said like, hey, we want to be a node in this network. We want to be issuing, we want to issue the M tokens, right? Instead of issuing our own just coin, the one to many model. We want to be a part of this network and like participate in the broader this many to many network that you're discussing. Am I understanding that correctly? Is that kind of what you're envisioning?
Yes, and there is an extra step because I might have insider information here, so I need to pay attention to what I say. But I mean, PayPal is not launching their stablecoin, right? PayPal is branding a Paxos-enabled stablecoin. So in order to issue a stablecoin, they are paying a provider who's paying a provider who's paying a provider who's building on the similar rails. So it is the backend is kind of the same. I think Paxos is trying to innovate, but I think that is part of one of these first generation innovators that is still attached to the legacy system. They are evolving as well. So I think I agree with you, but on top of that, I think PayPal could have issued their own branded stablecoin in way more sophisticated ways. I believe that for PayPal is a test, right? So like for them is a test, and they also, I mean, I know that for them is a test, and this stuff will also evolve as things go. And also, I think PayPal is another example where that reminds us that innovation typically comes from newcomers, because if you are an incumbent, you have a very big business, you need to be very careful how you push the boundaries of innovation because you have a very big business to protect. And that's the benefit of being a young company, where your modus operandi and your reason for existence is actually to disrupt. So I think your analogy makes sense. PayPal could actually have joined the network and mint M and use it, but it's one step further. By doing this, they could have actually disintermediated a vast proportion of the intermediaries of systems that they need to use in order to launch the Paxos PayPal branded stablecoin.
So following up to that, like, what are the types of institutions that you envision participating in this network? I'm assuming potentially like traditional banks, but also other types of institutions like funds, other crypto protocols, an entity like a PayPal. What other types of institutions do you see as being kind of like the core participants in this network?
I want to start because I am I am usually more opinionated and filtered than João, and then I'll give him the assist to continue. But I think banks are probably going to be the least parties interested in issuing, because banks have So what the stablecoin model wants to do is democratizing the banking model. So allowing many more parties in a hyper transparent and sometimes permissionless way to issue money. And because it's a very profitable business, and it should be a bit less profitable, a bit less risky, but more distributed. And banks do not like it because banks have a monopoly in issuing deposits. Banks provide loans and they store your deposits. They're losing the monopoly on loans because most of the high margin lending is done by funds. They're keeping the monopoly on deposits, and you have no choice, right? You want to park your money, you need to park your money in the bank. You're actually providing an unsecured loan to a bank. You really don't want that. You just want to park your money because you want to use it. But you know what? You're actually providing a loan to a bank that gives you no money. If they go down, you go down with them. So I think banks are going to be the last ones to join this revolution. I believe banks will ultimately transform themselves into custodians, and they will be forced to do that. But I think in our opinion, anyone who has rights to distribute money and connection to distribution venues, you mentioned PayPal is a great example, and has access to assets, could join the network. So for example, market makers, trading venues that are already doing most of the heavy lifting, exchanges, fintech front-end providers, asset managers, insurers, anyone. At the very end, banks will just decide that they lost the battle and they need to do that as well. But for the next 5 to 10 years, they'll try to convince us that they are the only ones who can store our deposits in a safe way, although evidence is actually is actually pointing more to the government as a last resort rather than the bank. But that's my opinion. I don't know what João thinks.
No, yeah, that's the way that we think about it. I think another way to say that, Aaron, is that there's, and we were touching on that before when we were kind of nerding out about money, but and this is the bit that people don't understand, right? What is the front end of money, or the applications, and these are the things that we use on a day-to-day basis, right? The paper cash we have in our pocket, or the dollar balances we have in the several apps we have on our phones today. And then there are things like the back end, like an account at the Fed or treasury bills, right? And in between, there's this humongous middleware of money. And as Luca said, and I like that word a lot, because I think sometimes we as humans, right, we assume that the world that we live in is the way it is because it should be the way it is, right? And it's almost like a godlike like definition that people have around these institutions sometimes. But banking is a monopoly. It's a monopoly on the issuance of deposits, right? And it doesn't necessarily have to be a monopoly. Again, 30 years ago, communications and media were monopolies, right? And the internet has disrupted that. And maybe people back then thought, oh, but maybe it's good that we have like a few institutions telling us what we should consume in terms of news, especially these days in the US. Perhaps some people still think it's a good idea. But then, like, the world just evolved into a completely different way. And I think it's better that we have democratization of access to that. In a similar way, if you maintain that core back end of money, right, an account at the Fed or treasuries or like government bonds in any other part of the world eventually, why wouldn't you attempt to like disrupt all this middleware and have it be democratized, right? Instead of thousands of institutions, like hundreds of thousands of companies potentially doing that on their own without access to intermediaries. So when you think about that from that perspective, as Lucas said, then anybody who has like distribution of digital dollars, anybody who has like customer relationships where the use cases have to do with digital dollars, they should be asking themselves, like, maybe in the future it does make sense for me to join a network like M0. Not because I want to be a stablecoin issuer, because that's kind of cool to also add to my website. That's not the point at all. It's because it's an additional business model, it's an additional monetization avenue for them, and it makes them more resilient, and it makes them more in control of the offering they have to their customers, right?
I want to add one extra thing just to make it even more clear, like practical example, because stablecoin is such a hot topic, right? So the M0 project has raised, I think so far, around $60 million to build a huge network. This is a lot of money. Not everyone has this luxury, and it's a privilege we have. Now, there are several projects that want to issue new stable coins because they see how profitable it is. They will go on their own. They will just like lose the battle because they will have less money. They will have less size. It will be very complicated to just replicate the stack. Why not joining a network and actually benefiting on the profits and just like, joining the network, a network that we care to be very big, but not making a lot of money, but be very big. There are several market makers that are making the heavy lifting by providing liquidity to some of the centralized stable coins. They are thinking about launching their stable coins. So why not joining a network? They know that liquidity transformation is bad. Liquidity fragmentation is bad. Now, we have several huge market makers in our cap table. We are having obviously strategic conversations with those guys. You have exchanges that want to issue their own stable coins because they actually have the distribution. So why not joining a network? So that you can see how this, like, it is like there's so many people thinking about it that even now they could just like join a network and be issuers of a similar token instead of just launching their own business, because it's a very saturated liquidity now and requires significant resources to scale.
Yeah, and I think the temptation, right, is such a strong one, right? The folks are looking at what Tether's doing, what Circle's doing, and it's like, wow, these guys are just camping out and just making 5% returns on these government bonds that they're holding, and it's just free money, and these guys are like most profitable company in history. How can we get a piece of that, right? So maybe the initial temptation is to be like, well, if you can't beat them, join them. Like let's just do the same thing they're doing. But so what you're saying is if we're joining the M0 network, okay, maybe we're not going to be just like harvesting this 5% yield from these, the same way that we would if we were doing this ourselves, but we'd be getting like a smaller cut of that yield essentially. as I'm assuming there's maybe we can talk about this more, like how the actual yield would be distributed amongst the other participants in the network. But the network effects would be so much grander, much broader, and over the long term, like your business models can be a lot more sustainable, and you'll be a lot more profitable over the long term than just trying to fight it out against Circle or Tether in the short term for these 5% profits or these 5% yields. Am I understanding that correctly? Like, is that kind of the idea? Like, where you're selling folks on the longer term vision of joining this network?
I think so, but also I don't think there is an alternative. I think if we want to break a monopoly and if we want to raise the quality standards to expand this economy, we need to do it together. There is no alternative to do that. And I'm saying this from the privileged position of being the CEO of a company that has raised probably 5 times the closest competitor. So I could actually play the heavyweight game, but I think it's a lost battle already, and I think we shouldn't do it. So I think that your point is absolutely correct, but I think even in the short term, people are realizing that we need to have some sort of like very smart collaboration and specialization across the stack if you want to break a monopoly that already exists, and that has subpar liquidity, subpar quality if we want to expand this ecosystem. If we think that crypto is what it is now and is a retail speculation game for token trading, we are perfectly fine as we are now. Now, I think as you mentioned before, I think this should be way more than this. So if we really want to expand it, we need to expand it with some level of specialization starting now. Otherwise, there is no future. Especially, and sorry, like João, I'm stealing too much of your thunder, but I think these things are so core to my beliefs. Especially, I think this needs to be a bottom-up revolution. In the same way Bitcoin was a revolution, we cannot really live this revolution to the 2-3 largest governments in the world or affiliated financial institutions. This is not what crypto is. Crypto is not electronic money payment rails. Crypto is not Stripe v2.0. Crypto is democratized, hyper transparent, government resilient money, and that's what we are building here.
I know you guys have put a lot of thought into the governance of this system. You have like a unique, like 2-tier, like 2-token governance model that you're proposing. And Luca, from what I understand, a lot of this is derived from your experience at Maker and some of the learnings that you encountered in the governance community there. Maybe we don't have to go probably super deep into the mechanics of it, but why don't you just talk a bit about like the vision and some of the problems you're trying to solve for, and maybe what situations are you trying to avoid potentially in the future by putting a lot of thought into governance right now?
Yeah, I'll try to be short about it. And I think it is absolutely informed by my own experiences, but this is the baby of one of the other founders of M0, of Greg. So I really don't want to take the credit for what he has been designing. I hope Greg is listening. But I think that like we have seen in crypto, certain tokens, like governance that has been managed through tokens, and tokens have some sort of proxy relationship with the success of the project and some sort of like governance rights attached to it. And what happens ultimately, and these have been distributed widely to like a long list of participants, typically retail, to protect some of the insiders from regulatory risk, et cetera, et cetera. This has actually created systems where no one votes, no one participates, because everybody is just buying the tokens to trade them. And there is a very small majority that is taking all the decisions and is hiding behind like a silent. There is a small minority that is taking all the decisions and is hiding behind a silent majority. When I was a Maker, I actually ran, because I wanted to have more checks and balances in the DAO. I ran the so-called LOVE campaign, and LOVE was lending oversight, was an acronym for lending oversight. Still a pretty good one, I think. Like Fight for Love. It's still the largest activist campaign ever run in the history of crypto governance. I personally called every large holder, institutional holders of MKR tokens, to vote in favor of what I thought it was important. I think some of the largest holders of MKRs joined, some publicly, like A16Z, Parafy, Standard Crypto, Block Tower, but there were many others that actually joined without officializing it. it was not enough. It costed me a couple of weeks of a lot of work, and I have good connections in the system. It was not enough to counterweight the opinions of the founder, one of the two founders of Maker. Actually, both founders. One is dead, unfortunately, now. So I wanted to make a point that this stuff is not decentralized. It's just decentralized in the name only. It's more of a theater. So when we decided to create a new governance system, we wanted to do a couple of things different. First of all, we wanted to split tokens. Like in the same way you split shares. You own Apple stocks because you want to participate to the upside, but you don't want to go to the assemblies and to the board of directors. You don't even have the right to, but you don't want to vote, right? You need to provide votes. Sometimes you don't care. You proxy them. So our idea is to split the tokens and have a voting token that gives certain rights to the holders, and let's say a utility token that captures some of the economics generated by the protocol and is easily traded. We think that this can actually split people that want to actively participate in the protocol and people who don't want to. On the voting token, we have been very aggressive. If you do not participate, you will be diluted out. So if you're just camping on those tokens because of whatever reason you have of economic upside or whatever decision, if you do not participate and take risk for that, you will be diluted out. So there is a huge incentive for those players to participate. And then there are certain security mechanisms to ensure that the system can actually expand towards decentralization in a nice way. The last thing we did, which is not very common in crypto, but it was important to us, we didn't airdrop the tokens to randomly to farmers. We really wanted to start keeping this tight. So currently, the M0 governance resembles more of an on-chain consortium rather than a DAO. There is no decentralized workforce. There is not a decentralized treasury. The tokens are in the hands of the team, the founders, the investors, the foundation. The foundation will probably distribute those tokens to strategic players. Like you mentioned, PayPal. If PayPal would join the network, I think PayPal should have voting rights in this network. But I do not think voting rights should be held by hedge funds who are actually just scalping the value of the voting token, or retail on Discord that have very strong opinions about monetary policy in their free time. So I think that what we're trying to do is something that is a bit closer to the shareholders economy that works pretty well in crypto. So we spent a lot of time to do that because I think good governance is the basis of any evolving system. And if you start bad, most projects in crypto said, okay, I'm going to start with some kind of good enough system and then I will fix it, and then you never fix it. And so we have all these decentralized DAOs that are not decentralized, are not DAOs. Nobody wants to vote. There are two funds and one founder decides everything. And every vote is opinionated. You have seen it on Maker. You have seen it on Uniswap. You have seen it on Arbitrum. And I think we can do better.
No, it's super interesting, and I would definitely recommend folks to check out the white paper to learn more about this governance system that Luca is proposing. It's really profound. I'd like to switch gears here and try to localize the conversation a bit more and talk specifically about Brazil, or maybe about, I guess, two angles here. I'd like to talk about how do you define the value that a system like this that you're proposing, that you're creating, what's the value that this brings to emerging market countries generally? So countries that have soft currencies that have been maybe on kind of the fringes of the global financial system to a certain degree. And then I'd like to also talk a bit about Brazil specifically, because Brazil's doing some of its own interesting kind of monetary, financial market restructuring with the Drex project, wholesale CBDC, tokenizing bank deposits, all this kind of stuff. And would like to get your thoughts on just how is something like this that you're proposing compared to maybe what some of these central banks are proposing with these two-tier CBDC models. Maybe João, we'll give you the hand here, and then Luca, feel free to chime in as well.
I think it's already an existing phenomenon, right? I think stablecoins have facilitated enormously this desire that I think exists. I mean, we all spend time in Brazil for different reasons, but I think we all have witnessed that in a country like Brazil, and then you can certainly throw a lot of others in that example. But people in Brazil, just to stick with Brazil for a second, people love dollars, right? I was reading yesterday, actually, that the Brazilian real, I think, has lost 80% of its purchasing power in the last 20 years, something along those lines. I might be wrong on the exact numbers, but something along those lines. I mean, when that is the reality of an emerging market, which it is for most of Latin America, for most of Africa, for a lot of Southeast Asia, you want, as a consumer or even as a business, you want to be exposed to other types of currencies, to other types of assets, and a lot of that has to do with assets and financial instruments that are dollarized in terms, right, that are denominated in dollars or even dollars themselves. And I think stablecoins, outside of, I think, crypto capital markets settlement, which is still like the majority of what drives its volume, I think there's an enormous amount of interest because that has facilitated tremendously the holding of dollars, right? So I have heard so many stories over the last 5 or 6 years of people's lives being changed because all of a sudden now they can swap, their hard-earned money for a little bit of stable coin on a digital wallet, and kind of all of a sudden go through a local crisis, or actually save in a way that they didn't ever think that they were going to save. I think that's just the beginning, but in a broader sense, what Luca said, it's the broader theme of democratization, right? I know that creates a ton of problems for these local economies, right? It creates a lot of problems around the usual capital controls and how people want to protect these currencies. But the fact of the matter is that I think people understand that we live in a global world today, and if they can have access, because now electronically you can have access to a lot more services than you used to have 3 decades ago. Dollars is just yet another electronic or digital use case that people want to have access to, and so I think that's the first thing. Then I think on the second point, and I'll let Luca join that conversation because I think it's super interesting. Brazil has always been a very interesting economy because I think it has suffered so much, just like Argentina and some other countries. But I think Brazil developed in a slightly different way, has suffered so much for financial, all types of different forms of financial crisis. Right? I remember my dad going to the bank with literally shoe boxes filled with cash so that the bank would be able to stamp the paper notes with 3 additional zeros. But I think that in Brazil, one of the outcomes of that is that it has developed the financial services technology and infrastructure tremendously compared to some other countries, because people just had to build software that could cope with all that like craziness of how money evolved. And I think now we live in a phase where Brazil is probably within the top 5 countries from an innovation point of view in terms of financial services infrastructure, and a lot of that is actually coming from government agencies, right? So I think Pix and Drex are super interesting from that perspective, and I think the philosophy that we have in the way that M0 works, we want to connect like this very base layer of what is money, and that changes from country to country, from currency to currency. But if something like a government issued wholesale digital asset, that does not attempt to be like actual cash for retail, but it can be sort of this raw representation of value for a particular economy. If that product actually exists and is well designed and it actually comes to fruition, it could be plugged into a network like M0 potentially for the wider distribution of what actually money would be in the use cases that businesses and consumers and retail would use on a day-to-day basis. So there is a there, I think, in how these things can evolve. But I'm sure Luca has ideas on that as well.
I always describe like the money distribution, how money gets in our pocket and why. It's a triangle of three actors. There is a state treasury, there is a central bank, and there is a commercial bank. The state treasury wants to make sure, so the commercial bank does most of the heavy lifting. They actually underwrite the credit, they distribute the money. It's complicated. Like you need to have many venues, you need to have like several use cases because you actually interface with the retail. Retail is complicated, and like they have many different ways they're using the money. The commercial bank is actually acting as the connection point between the central bank is acting as a connection point between the commercial banking model and the state. In most good economies, the state and the central bank are kind of separate. They never are 100%, but they are. Now, the state wants to make sure that this system works well because so they can dump their treasury bonds at below market rates. If it works well, like we have been subsidizing the U.S. economy at below market rates for decades because the dollar works very well and is like the reserve currency of the world. So this triangle is the same today. I think that states are friends of network, because if you are, for example, the US economy and dollars became way more distributed digitally and everybody uses them, you can finance yourself at even cheaper rates. Central banks are still friends of this network projects like M0 or crypto. Who is not a friend of crypto is the commercial bank. Because now what we're trying to say is there are better ways we can interface the consumer, the users, the financial applications, and we don't need you guys. So I think that this innovation is absolutely in sync with the CBDC efforts or similar efforts from governments and central banks, because these guys cannot interface directly with retail. It's very complicated. They will still need an intermediary. What we're trying to say is that we as a sector will be the new intermediary. And you see it now, like you mentioned, like João mentioned the PIX example. If you can run peer-to-peer payments that are immediately settled on central bank ledgers, why on earth do you need a bank that is storing that application for you to do it? You don't need it. They're just there because they have their position to protect. I mean, you could just have like a front end, which is maybe decentralized, that is actually hosting the PIX smart contract behind it that connects directly to the central bank CBDC, right? So I think that, in my opinion, the weak link here is the financial intermediation system, which is private, will be swapped by another set of private enterprises that will keep connecting with the central banks and the state. So we welcome innovating governments and innovating central banks like in Brazil, because we think we can do a lot of business together. The incumbents will try to convince them this is not the case, but they also have their own reasons to do that.
Well, it seems like that's been one of the tensions in not just in Brazil, but like just around the world, as far as central bank digital currency research has been kind of advancing over the last few years, and even out like the Bank for International Settlements and whatnot. There's just been this tension where, like, hey, it's a great idea, digital money, like central bank digital currency, and then you realize what the implications are, and it's like, wow, this basically means we're going to nuke the entire commercial banking sector, in our country.
Yes.
And like, well, how do we kind of like, design this 2-tier thing where it's a wholesale and a retail, and then it protects the banks, and then it, so it feels like there's been this tension where the governments are like, hey, this is great, we want to innovate, and then the banks come along and say, hey, like, you realize what's going to happen if you do this, right? So I mean, I guess, I think in Brazil they've with the direct system, it seems like they've found this solution where it's, hey, we're going to basically allow the banks to become kind of nodes in this network, and we're going to allow you to tokenize your deposits and issue your own stable coins against the digital real wholesale currency. But yeah, it's essentially about keeping these banks as maintaining their position as intermediaries in the system, right? As far as my understanding of it goes, which maybe that's a step, maybe that's it's probably not feasible to just like nuke the banks all in one shot, right? Like kind of João, to your point earlier about like the progressive innovation, like first we got to start with, uploading like a PDF picture of the New York Times to the internet, and then we'll move on to like actually putting like a virtual version of the New York Times on the web. So maybe this is all just, kind of a step towards, these are just the gradual stepping stones of this process, I suppose. But just the fact that I think you have governments like taking these questions seriously and really kind of trying to rethink like, what is the role of all these various intermediaries in the system? I mean, I find to be personally encouraging. I don't know if you guys have any other thoughts you want to add to that, but I have a couple other questions as well on just like, I'd like to wrap up with just kind of some roadmap questions. Like, where are you guys at right now? What should we be expecting over the next 6 months as far as the M0 rollout?
I'll just give one line about what you just said, and then I'll let João describe the roadmap. I think you're absolutely right on the innovation. I think we just need to stop talking banks. I think the governments want to have regulated nodes that they can trust. Today, these regulated nodes are banks. In the future, regulated nodes that they can trust to interface with retail could just be audited smart contracts. They don't need to be banks, buildings with branches. So I think the direction is definitely encouraging, but there is a lot of work to do to break monopolies. But this has always been the case.
And then the other thing I would add to that is that I think we are plagued also in the crypto industry. These things, in fairness, they are always like a zigzag, right? We zig too much, and then we need to zag the other way. But people like to say, we need more regulation. We need more regulation. I don't think we need more regulation in particular. I think we need better regulation. And to Luca's point, maybe what we need to do is to get regulators to start writing code. I don't know why some institutions think that writing code is for certain types of businesses and not for others. I think regulators should definitely start writing code and enforcing some of these rules in smart contracts, and hopefully by having the type of innovation that we're talking about, we will see better governance, but on chain without actually humans placing checks on forms. But then to move on to something more pleasant to talk about, roadmap. I think the way we have thought long and hard about how to bootstrap a network like M0. At the end of the day, all things need to go from 0 to 1, and we are going through that phase right now. So we're actually right now we're in the process. Maybe if we can have another chat soon, Aaron, we can give you more details on that. But we're right now in the process of onboarding the first few actors on the network, right? So we are onboarding the first minter on the network as we speak. We're onboarding the first few validators on the network and the first special purpose vehicle operator as well. And these are the actors. If you go and you read more about it on m0.org, you will understand the roles that all these actors play in the network, where we have essentially decentralized all the roles that folks play for robustness and decentralization perspective. But we have to start somehow, and we are going from 0 to 1 there. Another thing that we need to do that we are aware is we need to establish a baseline of liquidity so that people can convert into the various use cases where stablecoins are used today in and out of M, and we can start having people experiment with M in those use cases. And then the next phase for us from a roadmap point of view is really to grow the network, right? So we will apply the significant resources that we have to grow the network from that point of view. We're going to welcome, as we were talking about, a multitude of minters, so that this really becomes a decentralized and well-governed money issuance network. And we have a lot from when it comes to the M0 Labs, to the company that assists in building sort of software for the ecosystem. We are very focused on making sure that for an entity that is interested in joining a network like M0 and becoming a minter of a fully fungible stablecoin, that entire process from deciding to do that all the way to actually becoming an issuer is as easy and as automated as possible. So we have a lot of ideas for how to automatize all that onboarding process. And we want ideally to eventually have a process that is as turnkey as possible. There's always going to be a lot of governance and a lot of off-chain paperwork and contracts that need to be signed by all these parties, because effectively they self-organize and they participate in this network. But there's a lot of super cool ideas for how we think that software can assist on the automatization of that onboarding, and also assist in integrating AM with more and more use cases, because as Luca said, we have put a lot of capabilities on software, and particularly on chain, in how the upside of a network like M0 can be distributed across the participants, how the various fees and yield that gets collected gets routed in. And there are a few more things that we're going to launch in a couple of months that will facilitate, I think, new use cases to be built on a network like this as well.
Well, Luca, João, really appreciate your time today. This was super interesting. Really enjoyed this conversation. Would love to just turn it back for any quick final thoughts, and then how can folks get in touch if they want to learn more, or if they want to maybe potentially contribute? What's the best way that folks can find you all?
Yeah, the easiest way is to go on m0.org, the project website. We are pretty active on Twitter as well, on the foundation account, which is M0 Foundation. And as I said, I think the main thing that we're open for business folks like myself, Luca, and a lot of the team now is just hearing from people who are interested in joining the network. I think we are getting to that phase now. After bootstrapping the network with the first few actors, we're super interested in talking to anyone who is thinking about issuing their own stablecoin, who's upset with the amount of deposits they have of stablecoins and not participating in upside. Those are all conversations we're happy to have.
Yeah, and soon enough, you will start seeing significant amounts of M as an ERC20 token floating around crypto, and hopefully being more and more liquid across the ecosystem, and more used by protocols, bridges, alt chains, large holders, teams that are funded by venture investors, market makers, etc. The next 12 to 24 months will be heavily invested in doing this, expanding the ecosystem.
Amazing. Great. Well, thank you so much, Luca, João. Thanks to everyone for watching today, and we'll see you next time with another great episode.